Initial public offerings, IPOs, maximize your offering price. Disclaimer, this is not legal or investment advice. Seek competent advice from competent people. Your situation may vary. The more you know about finance and business, the more you can profit. This will show you how IPOs are valued. Knowing how IPO underwriters see IPO pricing is key to positioning your company to maximize its valuation. There is nothing Wall Street loves more than growth. I'm going to reveal here an evaluation of some IPOs we prepared in November 2011. This is a preliminary analysis of these IPOs, completed and planned IPOs, that we prepared for a similar client company that was considering going public. When you attack the market with these kinds of quantitative tools, you find that the mystery falls away and you can see clearly. Your underwriter will prepare studies like this to show what valuation he can use to market your stock in your IPO. So here we have Angie's List, Friend Finder, Groupon, LinkedIn, and Zynga. Now take a look here. The PE ratios and the price sales ratios give you, in effect, the relative price of each stock. Angie's did not have earnings. Price to sales ratio 5.4. Friend Finder, price to sales was very low. Groupon, very high, 12 and change. LinkedIn, almost 7. Zynga at that time was not public yet. Now here we have the same companies with other metrics. The key ones you want to look at here are revenue growth percentage and value per user, especially revenue growth percentage. Angie's List, 48% growth. Friend Finder, a little bit down. Groupon, almost 700%. LinkedIn, 120%, and Zynga. So we have Groupon winning the race. LinkedIn a far second, Zynga third, and Angie's List fourth. So look up here at the price per sales. You'll find the same thing. Groupon winning, LinkedIn next, and then Angie's List with Zynga not public yet. It is important to note the metrics we use. We use revenues, revenues per user, and revenue growth. These metrics were mentioned in public discussions about these companies. Now here's a discussion of each company. As you can see, they all have their own characteristics that have to be taken into consideration in evaluating the whole group. Angie's List is unique and all of its members pay the services to provide customer written reviews of local services. All of their subscribers pay cash money, so the revenue per user is high and the value per user is also high. Friend Finder is an online dating service. Their IPO crashed and they were being sued at that time. Things like this can happen if your deal is mismanaged. Note the low value per user, low revenue per user, and lack of growth. Groupon had shown the most growth of any on the list. If you look at the value per user column and compare it with the rest, you can see the premium the market put on their growth. LinkedIn with less growth than Groupon was being valued well. Investors perceive the LinkedIn users are locked in, unlike Groupon's. Note that Zynga had a strong value per user. This is interesting as there were doubts even then about its ability to keep momentum in a fad business. Summing it all up, what can we learn here? To me, revenue growth jumps out as a key driver of stock value. Groupon, LinkedIn, and Zynga all had strong revenue growth coupled with strong revenue per user. The more you look at this, the more you understand that growth drove their value. We now know that Groupon and Zynga failed to continue their growth, and as a result, their stocks crashed. From this chart, we can deduce several things. First, while the market valued revenues, it discounted profits almost entirely. To me, revenue growth jumps out as a key driver of IPO pricing in these types of companies. Growth of revenues is the key metric. Take a look again. Forward PE, LinkedIn is actually higher than Groupon, but the price to sales ratio, Groupon wins, LinkedIn second, and Angie's List third. Now here we have the revenue growth. You find the same order. Groupon almost 700%, LinkedIn second, Zynga third, Angie's List fourth. Therefore, you should focus on growth, customer lock-in, and having a unique service in your company. This will increase the amount you raise and minimize the cost of dilution in your IPO. This is only a beginning. We can show you how to maximize the value of your stock offering. Want to know more? You email me john.lux@securities-law.info, john.lux@securities-law.info, phone 240-200-4529. You can get my books on Amazon, including How to Find a Home Run Stock. Talk to you soon.